Yeah, good evening, everybody, and thanks for your time. I'm just sharing my screen with you all so I can get started. Yeah, there will be plenty of time for Q&A after the presentation, which should go for about 20-25 minutes. I've presented a number of times to ShareSoc over the years. This is perhaps a more pleasant one after the last close to 3 years of turmoil that's been created for us by the pandemic, and it's seen, especially in the last. Well, it's been in less than the last 6 months that the company's really seen a turnaround in its fortunes as the pandemic recedes. The aviation industry starts flying again in great numbers. Passengers are returning, and the opportunity for leasing is now back in. Feels actually better than what it was pre-COVID. So this will be a very similar presentation to what we released 2 weeks ago, which is available on our website when we released our full year financial results for 30 June 2022. So there's a standard disclaimer, which and I'll also make the presentation is actually available on our website. But if anybody wants to reach out to me directly, I can also send them a copy. And also, you can reach out to me directly if you've got any questions that you don't feel were answered, or think of other questions after the presentation. I'm happy for ShareSoc to share my email, or you can find it on our website. It's richard.w@avation.net. Anyway, thank you for your time today. As I said, 30 June, the results for 30 June 2022 has produced a return to profitability for the company. We not only did we do that, but we increased our net asset value per share significantly. We maintained cash and liquidity all through the COVID period, and we've managed to do that for the period ended 30 June as well. But during that period also, which is probably the greatest achievement, so we materially lowered our net indebtedness, and we also enunciated a new alignment and strategy towards a low CO2 emission strategy, which the aviation industry will necessarily need to take up over the next 5 to 10 years. But we're aligned with manufacturers that are leading the way in that field, and it's a relationship that we're extremely proud of, and we do see, in terms of planes, that we've always specialised in fuel efficient planes, but certainly the more fuel efficient they are, the lower emissions. But with the usage of and certification of sustainable aviation fuels and so on, the whole industry will need to move to that space, so whether it be regulated or whether it be required by customers. So we think the company's in a good position to return to the sort of business and growth that it saw pre-pandemic. There is still some work to do cleaning up the mess after COVID, and I'll provide that in a couple of slides towards the end, which set out our pathway and our strategy moving forward. The 2022 financial results reflect the end of the pandemic, effectively, or that's what our call is on it anyway. And it shows a return to a high level of utilisation for our fleet. A lot of our fleet was underutilised. We had a big chunk of our fleet sitting on the tarmac, not generating rent after we got back 21 planes out of the close to 50 planes that we had at the start of COVID, because airlines simply went bust. And investors and people who know the company will know that our biggest customer, Virgin Australia, was the first airline to go bust as a result of COVID, and that was over nearly 2.5 years ago today. So that was a big hit that we had to, which was created an existential crisis for this company. There's no question about that. So we weathered that storm, and these results do show a turnaround in our fortunes. So there has been a significant recent recovery in passenger numbers, and we're talking, post. We're talking really, we only started seeing that February, March onwards. So it was really at the last quarter of the financial year. The company is optimistic about a future for the leasing industry, as we know that the global fleet was shrunk during COVID because old planes were retired. There are also planes that were nationalised when Russia invaded Ukraine. Over 500 planes came out of the global fleet, and they will never return to the global fleet. Those planes need to be replaced. And so the opportunity for leasing, we're in that sweet spot where the demand for aircraft exceeds its supply. And that's been exacerbated because the manufacturers out there today are still only producing about half the planes per month than they were pre-COVID. So we're in a really good phase for the industry where airlines are requiring to up their capacity to put new planes in their fleet so they can service customers. And yet those planes are very hard to get. And so that is great for aircraft valuations, and it's also fantastic for aircraft leasing rates. And those are the two key things that this business needs to succeed. So our fleet utilisation has improved simply because all of the most of the unutilized planes that we had, we've either repositioned them with new customers or we've sold them. And we've in effect shrunk the fleet pre-COVID. And the significant impacts of airline insolvencies and the restructuring of some of our customers have all been reflected in effectively previous periods. And now we're starting to see distributions from those insolvencies, and we're starting to receive them. And the company is seeing increased levels of interest from airlines to buy or lease aircraft at sustainable lease rates. Senior lenders are jumping back into the market and are willing to lend against aircraft assets. And we're seeing the utilisation of all our aircraft with all our customers increasing. And these factors simply confirm the emergence. And anecdotally, I'm sure all the people listening to this call know that the airline and aviation industry is returning back, and they're struggling to actually return back as fast as they're needed with all the queues and problems that have been occurred. But that is a positive business sign, as much as it must be frustrating for those individual travellers. So in the future, the company will focus on leasing modern, low CO2 emission, fuel efficient aircraft. We are supportive of the industry's goal of becoming more sustainable through a transition to new technology and the use of sustainable aviation fuel. And and the company will position itself in the next 6 to 12 months for a return to growth through opportunistic aircraft trading and deliveries from our order book in this post-pandemic environment. So just onto a snapshot of the company. We had at 30 June 39 aircraft, and that was, as I said, down from close to 50 pre-COVID. So we have shrunk the fleet a little bit, but it hasn't been massive. We serving 17 customers. We had 19 pre-COVID, so we lost about 4 or 5, but we've gained 2 or 3 back, and they're in 14 different countries. We mainly specialise in regional narrow-body aircraft, and we've got a couple of wide-body aircraft as well. The wide bodies make up about 17% of the fleet by value. Narrow bodies are about 52%, and the turboprops, which we've always been a niche product and certainly a leader for us, represent about 31% of the fleet by value, but are the greatest plane by number because the smaller planes are obviously a little bit cheaper. The aircraft fleet is very young. It's got only 5.6 years old on average. And those planes have just under 6 years to run on average on lease. And so our total assets is over $1.2 billion US, and we are a US denominated company. And so the weakening of the pound in the past couple of months, and certainly in the last couple of weeks, this is we effectively hold US dollars, so it is a bit of a hedge against that. So it should be actually relatively positive for our share price, amongst the other positives, including the turnaround to profitability. So attached to that fleet is just under $570 million of unearned contracted lease revenues and receivables. And so that from that number, over 6 years, just under 6 years, just under $600 million, that our steady state run rate for lease revenue is just under $100 million a year. So the company remains pretty well intact, and it's those long leases that really kept us in good stead as we maintained liquidity and cash through COVID and enabled those and supported our airline customers to survive. We now get the benefit to run out the rest of the 6-year leases. And so we've taken the pain, we have survived, we've fought all the fires that we needed to fight. Now we start to look positively towards the future and a return to growth. So we've maintained a full team. We've started adding employees to the team, and that's because we think we're going to come into a very busy period where the demand is there. And we're also what we're enabling our team to do now, as a result of having resolved a lot of the COVID issues, is that they can focus on future business rather than fighting fires and dealing with problem airlines or insolvent airlines or repossessing planes and all of those sort of things. So a lot of the team can now start focusing on what we did best and what we did so well for 14 years pre-COVID. This was a company that used to double its fleet about every 3 years, plus 25% growth rate. We were paying a dividend, we were growing the revenue every year, we were growing the bottom line every year. This is a company that if it can go and access aircraft and find new customers and then borrow at reasonable rates, can go out and do that again. So we are, currently looking for new business. We're engaged in a number of campaigns driven by demand from the airlines to build and renew their fleets for the delivery of new aircraft. So just having a look at our fleet today, there's the 39 aircraft. It is focused already on fuel-efficient regional and narrow-body aircraft, and it's those sectors that are flying at pre-pandemic levels already. The wide body, the long-haul international routes are taking a while to catch up, but they are catching up very quickly. But 83% of our fleet by value is focused on those regional and domestic routes, and those are the planes that we will certainly be focusing on in the future. It is still a difficult investment choice for a company like us to look at the larger wide-body aircraft, and we do see so much potential in the ATRs and new technology narrow-body aircraft moving forward. So our business model has always been to buy brand new planes, try to put them on 10 or 12-year leases. People have heard me speak before, know that the average yield on an aircraft is around 10%. So a $100 million aircraft will generate $10 million of rent per year. It's as simple as that. $20 million aircraft, $2 million rent per year. And then you work your way backwards from there. So, we put, when we sign a lease, it's for a fixed rate per month for like 10 or 12 years. We then put a mortgage on that plane for the same duration as the lease, so 10 or 12 years. And of course, if you get 10% yield per year for that period of time, that plane will pay off its mortgage inside that first lease. And planes, if you don't know, have a typical useful commercial life of about 25 years. So the plane pays itself off in about 10 to 12 years, less than halfway through its life, and then generates effectively free money from there. So that asset is generating a great return. And if you compare that to property returns, clearly, this is a compelling investment. And all it needs is obviously a positive operating environment, which it had for 48 of the last 50 years effectively. Passenger numbers went up every year. Airline tickets were commoditized, and you get very cheap tickets, and so it wasn't a luxury good anymore. And that just that really accelerated passenger numbers and sent them exponential. And that's how people expect to get around nowadays. And we're not replacing it with anything in the future, but there is a real opportunity over the next 5 to 10 years for airlines to reduce CO2 emissions by around 80%, and that's what we're on board with. That's what the industry is on board with, and so that necessarily predicts that we are going to focus on newer technology aircraft, the most fuel efficient types, and the ones that are certified for sustainable aviation fuel. So those new planes obviously have a longer useful life, carry a lower risk of obsolescence, great obviously long-term cash flow. And they're the planes that people want to fly on. So we, as well as the 39 aircraft that we have, we've got orders for 2 ATRs and then another purchase rights for another 28 aircraft. Now they're roughly $20 million aircraft. Now I said in the previous slide that our total assets are 1.2 billion. If we go ahead and add those 30 aircraft to the fleet, that'll add another 600 billion in fleet, 600 million in fleet, which is 50% growth. Now, pre-COVID, we were adding 5 or 6 ATRs to the fleet each year, over $100 million of ATRs to the fleet each year. So you can see us, that's what we're hoping to return to. And so there is a good pathway to growth. We do have great pricing on access to aircraft at a time when aircraft are hard to get. So that is a valuable asset. The 2 orders that we have there, we've made pre-delivery payments on those aircraft. They're not going to cost us much to deliver them into our fleet. The remainder of the purchase price we expect to debt finance, and so there's no cash drain from delivering those couple of planes into the fleet. So we're returning now to a high level of operational efficiency, which simply means that the high percentage of the fleet is generating rent. We had more than a dozen planes sitting on the tarmac on average over the past couple of years, not generating any rent. And effectively, we got 21 planes back from a variety of airlines during COVID. And we have either sold or repositioned 17 of those aircraft. In the next week or so, we'll be delivering the 18th or repositioning the 18th to a new customer. And we expect to sell the 19th one by Christmas. So, we're then left with a couple of aircraft, which we expect to be able to deal with in the next couple of quarters. And that would be every problem aircraft that was generated as a result of COVID will have been dealt with. And I think that returns the company to something that it looked like pre-COVID, in that every aircraft in the fleet was generating rent. And that's not an end point for us. That's a starting point. And it's a very important point, because, what we've been doing over the past 2 years is actually fighting all those fires, repositioning those aircraft, trying to either release the equity and the cash in them or return them to generating rent. And so that puts us as a starting point where, we just collect the rent on the planes every month. And then what we worry about is adding new planes to the fleet, adding top line revenue, which will grow the bottom line profits. And, that's how we managed to grow the company previously. So we're getting back to that position, and we think we're going to be there pretty quickly. So during the year, we reviewed the values of the aircraft, as I said, with lease rates, with the aviation industry returning to strength. But we've seen values of aircraft go up, and even to 31 December, we had taken further impairments on our fleet. And I think during the whole of the pandemic, we took over $130 million in impairment. And so we've simply reversed a very small portion of that impairment that we took during that COVID period. So, and it's backed up by, we're seeing, valuations and lease rates go up. So it is supported by that. So if you look at quickly at our customers, there's the 17 customers in the 14 countries. They include five flag carriers, which tended to do quite well during the pandemic because they were supported by local governments. They might have got even equity support by their governments, and they also flew domestic and regional routes, and they also bounced back the fastest. That geographical spread and diversification of our fleet really helped us survive during COVID, because in the first year of COVID, the Asian countries the Southeastern Asian countries weren't that badly affected by COVID. But Europe was, and then vice versa in the second year. So what we were able to do was manage our customers at the times that they needed. And so, that we have tended always to like those areas, and we've tended to avoid areas that we thought had a lot of geopolitical risk, like Russia, like China, virtually everything in South America. And so, and Africa as well. So, we were always cautious investors in our fleet and where we put, and with the airlines that we dealt with. And we think that has been a key to our ability to survive and with such strength throughout COVID. And that really is just our investment philosophy. We're cautious, we like to be diversified. Our investment criteria look at airlines, credit ratings, geopolitical risk, seat configurations, engine types, all of these things. So, we go through a rigorous process to try and minimize and mitigate that risk. And we think that that's sort of been proven throughout COVID, because we had good planes that we were able to reposition or sell, and most of our customers did well in what was obviously a terrible environment. So a couple of big things have happened really since 1 January in that second half to really give us the positivity to move forward. Philippine Airlines, which had our largest plane, a Boeing 777, completed its restructuring on the 31st of December. they under that successful restructuring have kept our plane. They've made payments to us, and they're now on monthly rentals, and they're current with that monthly rent. And so we extended a loan facility. We sold some planes. So all of these things are getting into this sort of position that I mentioned in the last slide, that real starting point to move forward with the company. So that's if you look at those statistics in terms of number of customers, fleet size, fleet numbers, that's why we do, being able to conserve the majority of those. That's why we do believe our business, we know the business model works in this environment, but also the company's effectively remained intact. So we've included there a list of our customers and the aircraft that they have, just to provide a bit of granular detail for those who like to do a little bit more analysis. And we have currently only 4 unutilized aircraft, which include an ATR, which is being transitioned in the next week or two. We had to repossess that aircraft out of Myanmar, not as a result of COVID, but as a result of the coup. So, a little bit more bad luck, but just add that to the pile that we had to deal with. But that plane's found a new home. We've got an ex-Garuda Boeing 737 that we expect to sell by Christmas. And then we've got a couple of old ex-Virgin Australia ATRs that we're running a number of campaigns on. So we've never had any exposure to Russia. There are no sanctions that we feel impact us or our customers. The very few customers that we had that flying into Russia obviously are not doing that, and it wasn't a very large part of their business either. So from that perspective, we do think that we've gotten through it in a relatively good state. So if I move on to our a summary of our financial information, we generated a total income of $116 million with revenue of about $112 million. Operating profits saw a dramatic turnaround to $90 million profit from a loss of $62 million, $170+ million turnaround. Profit before tax, before non-cash loan modification charges, saw a $150 million turnaround to just under $35 million profit from a loss last year of over $120 million. So we highlighted that profit before tax number pre those charges due to the material non-cash charges skewing the profit in a negative way as a result of loan modifications that we needed to undertake during the COVID pandemic, and then simply their treatment under IFRS 9. The extension of the maturity date of the warehouse loan and the terms and conditions of the unsecured notes were accounted for as this is the reason for it, was accounted for as a substantial modification to the terms of the debt instrument in accordance with IFRS 9, which led to a non-cash gain being recorded last year that then needs to be amortized over the next 5 years. That amortization charge this year was 8.8 million negative. So if you add that back to that profit after tax figure of $17 million, you start getting close. And then there was an additional further $3.5 million charge when we extended our aircraft warehouse loan facility out to 30 September 2026, which was a great benefit to the company. So this resulted in a total profit after tax of $17.1 million, which is a significant turnaround from the loss of just under $85 million in the corresponding period last year. Total assets were down by 5% to just over 1.2 billion. But when you compare that to net indebtedness alongside that, which dropped from 922 to 792, a drop of over $130 million, that's close to 15% drop in net indebtedness. So a significant improvement in our equity and our balance sheet. It's part of debt capital liability management that we've been focusing on, and we will continue to focus on over the next sort of 6 months as well, because getting your balance sheet in order as a result of all the damage of COVID, then it really enables the company to springboard in the future. So earnings per share were 24.7 cents, up from a loss of 131 cents last year, and NAV per share rose by 63% to £2.68. From £1.64 a year ago. That obviously NAV, because we're denominated in US dollars, that NAV 2 weeks ago when we released these figures was over £3 per share. And if you look at the share price today, right now, in fact, which I'll do for you. The company is trading at 99p, so that's probably the largest historical discount to NAV per share in the history of the company. And while it was mentioned that we're obviously, I didn't know that we were in the top 40 performing stocks in the last couple of months. We still think that the company is significantly undervalued. And historically, that suggestion would be proven by the fact that pre-pandemic, we typically traded at around or just a small discount to NAV per share. And right now we're trading at a 66% discount to NAV per share. So we'd like investors to have a look at that. We think that these results are taking investors by surprise. We know it's obviously there's a lot of negativity in the UK with what's going on there politically and economically at the moment. And so we think that people are, there's not a lot of positive investor sentiment out there, but we're trying to bring attention to our turnaround after the 2.5 years of pain that we've had to suffer. So we do think it's worth considering. So some of the things that we achieved during the year, we sold 5 planes. We're selling a couple more in the next couple of weeks. And we've extended leases on a couple of aircraft. That airline then took a 3rd aircraft. The PAL restructuring was completed, as I mentioned. We leased an ex-Virgin ATR and delivered it to a new customer last month. And as a really good data point for all the listeners that are investors that are listening to this, is that EasyJet, one of the better airlines on the planet, extended a lease on an Airbus A320 for us by just under 4 years. And that they're an airline that had no problems getting access to brand new aircraft when they reached 10 or 12 years old. And that's what they typically normally did. But they appreciate that they're having trouble adding capacity at the moment. So that is a great data point that shows where the airline industry is at. So in terms of transitions, we repossessed a Boeing 737. We expect to sell that plane by this Christmas. We also got back an Airbus A320, which we transitioned to a new customer, and we took that plane out of Golden, Myanmar, which is going to a new customer in the next couple of weeks as well. So we've been extremely busy, but as I said, it's been more like fighting fires and positive. This is one of our busiest years ever, but it's been firefighting rather than adding new and positive and profit generating and revenue growing additions to the fleet. So just a quick slide on our debt position. Total loans and borrowings dropped by 13% to 828 million from 948 million. Net indebtedness declined by almost 130 million, as I mentioned, to 792 million. There was a slight increase in the weighted average cost of the group's secured debt facilities from 3.9% to 4%. And the average cost of debt was 5.7%. Most of our debt, and investors will, I'm sure, be asking this question, 90% of our debt is at fixed or hedged interest rates. So this rising interest rate environment has no impact on the profitability of the company with its current fleet in a steady state basis. Obviously, every new plane that we add to the fleet will need to be financed at current debt charges, but banks are lending secured debt against aircraft again. Lease rates are going up. Lease rates are highly correlated with interest rates. And so we are a yield business and we're a spread business. So that 10% yield that we've got, if you can get debt for 5% and then you add 3.5% depreciation, maybe 1% or 0.5% for admin costs, that's how we make money. And it's as simple as that. There's no magic to this business other than that calculation that I just described. And so, we're confident that we can get those access to aircraft and access to those finance rates again. And that's how I think how we're going to be viewed and in terms of investors rating our performance over the next year or so. And just finally on this slide, our net debt to assets improved to 65% over the past year from just under 74%. And just there's a couple of ratios there. I won't spend a lot of time on this. I've already mentioned the net asset value per share increasing. Our lease yield stayed around 10%. Admin expense as a function of revenue is around 7%, which is industry leading. Debt to equity improved. Net debt to EBITDA improved. Obviously, debt to total assets improved, as did EBITDA to interest expense. So getting to the last couple of slides now. This is a liquidity update, quite a busy slide, but because we focused so much on liquidity during the past 2.5 years, we've really tried to provide a lot of information to all our stakeholders in relation to our liquidity. Total cash, over 120 million last year, still 120 million this year. But we've certainly significantly increased our unrestricted cash, which is cash that we can effectively use for anything. And that's gone up by, I think, about 40%, up $10 million. Finance lease receivables, future revenue, that's increased by 20%. And we still have 3 unencumbered aircraft in the fleet. And why unencumbered aircraft and they were same as we had 3 last year. Why they're important is that you sell those planes, you can either sell or refinance those planes to generate extra working capital with which to grow or repay debt or what have you. So the more unencumbered planes you have, the stronger your liquidity position. Not only that, we improved our loan maturities and extended our warehouse loan. All our debt's current, all our covenants are in compliance with or waived by our banks. We have unsecured bonds out there, which are expensive. So, they have an 8% coupon rate. They represent, of our, whatever it was, $28 million of debt, they represent whatever it is, 40% or something like that. So we have a real difference. Our secured debt's at 4%, and our unsecured debt's at 8%. So this is the problem. And this is one of the things that I think investors will be looking for us to improve over the next year, simply because, that sort of debt at those sorts of rates really bites into our profitability. So the more that we can reduce that over the next 12 months, the better the company is in a position for the long term and to generate long-term profits because it'll have lower interest expense. And that's how you return to that sort of profitability and to being a dividend-paying company. So we started buying some of those bonds back. We did a transaction where we bought $4.5 million of those bonds in July for about $3.5 million because they're currently publicly traded and they were trading, and we bought them at that point in time for 75 cents in the dollar. So that's a fantastic trade. If we can continue to do that, we can materially lower the impact of that expensive debt on the balance sheet and profitability moving forward. So additional liquidity that we've got in 2023, we're selling some more aircraft in the next couple of months. We've got those unutilized aircraft and unencumbered aircraft we can either refinance or sell. We can refinance other existing aircraft in the fleet. And we've started to receive distributions from Virgin Australia and also Philippine Airlines. So, we expect our that focus on liquidity. We can tone that down now because we're out of that that real shock period that created COVID, where airlines simply weren't in a position to pay their rents. And last year our cash collection rate on revenue was about 67%. This year just gone, it's 108%. Huge turnaround. And that is probably the most important data point that I'll give you in today's presentation, because that is irrefutable evidence that the industry is back on track. Their customers are paying, and that we're starting to collect all that money we weren't able to collect during the COVID period. So we expect liquidity to continue to improve over the next sort of couple of months as we sell a couple of aircraft. We'll sell 2 ATRs, and I think we'll sell the 737 by Christmas. Other positive cash flows include that we're remarketing the 2 ex-Virgin ATRs to either lease or sell. We're collecting debtors from customers. We're looking to refinance some aircraft as well, collecting from those insolvency proceedings, and potentially selling some Philippine Airlines shares that we got as a result of their restructuring. So these are all, the Virgin Australia last month made its initial distribution to creditors of 5.4 cents in the dollar. We had a $100 million claim. We've been waiting on that money for 2.5 years. There is still more money, another 1 or 2 cents in the dollar coming from that administration. So these are all the things that we've been waiting such a long time for. So the question I often get asked is there a cash crunch coming because we deferred loans or anything like that? And the answer is no. This is the debt maturities over the next sort of 6 or 7 years. And it just shows that, we paid $130 million of debt back last year. And here you see, our debt commitments next year are only $64 million. And so that gives us the ability with any extra cash flow to start looking at these cheap unsecured bonds, which aren't due to 2026, but if you can buy them at a deep discount cents in the dollar, it's a great trade and obviously improves that company moving forward. And I think that investors will be looking at that. And I think the share, anything that you see on that, is a real buying signal for this company, because we've done a lot of work on net indebtedness in the last year, and we intend to keep working on it over the next year to really position the company's balance sheet into a position of strength again. So just on our pathway forward and strategy, and then I'll finish off. So our strategy to preserve cash and liquidity and reposition or sell aircraft from customers has been successful. All the statistics that I've just given you in this presentation. And the implementation of that strategy has enabled the company to materially lower its indebtedness, support our customer survival. And so customers that were asking us to defer rent are now asking us for more planes. So we maintained adequate liquidity and kept that core business intact. And so now that the industry is returning to some positivity and there are opportunities increasing, we'll transition to a more forward-thinking and positive strategy that is intended to return the company to growth. We were such a strong growth company prior to that. We still got some work to do on debt liability management, but that's the two key focuses: debt liability management and that return to growth. So the return of air travel and the confirmation that passenger demand around the world has surprised to the upside in the last 2 to 3 months. You've got to remember that Omicron was a big event, November, December, and everyone thought that COVID was going to last another year. And it's amazing where we are. It's October, 10 months later. And it's amazing how the industry has really bounced back, and the pent-up demand for travel and business travel is strong as well. But people's desire to travel, to see friends and family, to go traveling and be a tourist again is absolutely still there. So, the rumors that people were talking about during COVID that, travel behaviors change, it's just simply not being supported by the evidence. So, we are going to, focus on those couple of things. In the short term, what we're going to do is reposition or sell those last few aircraft that we have. We're going to boost our liquidity with those sales and by collecting debtors and things like that. We are going to look at debt, further debt liability management and reduction of net indebtedness, presumably, with a more focus on that more expensive debt especially when it's trading at a discount. The opportunities for our ATR's order book is fantastic. ATR announced the release of a new engine that's going on all the new planes in the next month or two, and that engine is more powerful, more fuel efficient. Will be certified for sustainable aviation fuel probably in the next year, and one of our customers also completed the first ever commercial flight with 100% sustainable aviation fuel, a world first, and that was done in the last couple of months as well. So we're definitely heading that way. The transition isn't going to take months, it's going to take years, and sustainable aviation fuel isn't economically viable at the moment, but with government regulation, with support from the industry, with subsidies for people to grow the crops to create sustainable aviation fuel, we do, and with companies like Ryanair planning to use a big percentage of sustainable aviation fuel in the next sort of coming years, the momentum and the pathway is already there. And so we're lucky to be aligned and strongly aligned with ATR, with our orders and with our historic trading with them. And we are a small lessor that's always done well, simply because a lot of the big lessors didn't want to focus on those small ATR aircraft. Well, those aircraft are some of the best in the world. They're the only thing to fly those regional and some domestic routes as well. So as I said, our team is now focused on identifying new customers and growing the fleet. So this is a tiny little bit more about, this slide's from ATR, about the low CO2 emission aircraft. As I said, I talked about that engine going on wing. That'll be on all our future orders of aircraft. Won't be retrofitted. Those aircraft will just grow old. They're already fuel efficient, but the new generation engine is good, and they're actually planning the next generation after that, which they expect to be a hybrid engine. So there are fuel savings coming, and there'll be a greater use of sustainable aviation fuel as well. And this is already, the ATR is already one of the most fuel efficient aircraft on the planet per seat per hour. So we're starting with a winner, and we're backing that winner to do well in the future. So just onto the final slide before I open up for questions. The disruption by COVID is really receding from our industry. The vaccination programs and the opening up of restrictions has enabled that return. We see that in regional domestic travel and now even in international travel. The war in Ukraine hasn't had any significant on our customers or our business, and our business and business model remains intact. The completion of a couple of big items like the Philippine Airlines restructuring, payment of the initial distribution by Virgin Australia, the extension of our warehouse loan facilities to resolve some of the key remaining problems inflicted upon us by COVID, and it enables us to then turn and think more positively and aggressively towards growth in the future. Cash flow from operations continues to improve as the return to normal trading conditions means that our customers can pay their bills. And cash inflows for the remainder of the year will be boosted, as I described, by aircraft sales and collections of debtors and so on and so forth. So we're now just about right-sized the company post-COVID, and we are looking to return the company to be a long-term, profitable, dividend-paying company that it was pre-COVID, and it will have a focus on low CO2 emissions. There are going to be great opportunities for us to buy aircraft. Not only are airlines, their balance sheets have been damaged, so they're going to use leasing more than ever. But you have other lessors and airlines looking to sell aircraft to strengthen their own positions. And we've got a good order and supply book with those ATRs. So we're fully invested in the company. The team and management remain intact. It's been a hard couple of years, but we're finally we think we're breaking off those shackles and starting to look positively and happily towards the future. So that's all I have. I'm quite happy to open up to the Q&A session now. So let's just proceed with that. Paul, are you going to ask the questions, or do you want me to read through them?
No, I'll ask the questions, because otherwise I won't get paid. No, I don't get paid. I do this for the love of it. But it was a very interesting presentation, Richard. And actually, as you were going through, I jotted down quite a few questions that I have myself, and you managed to answer them as we went along. So it's not often that happens, but it shows that A, I'm awake, and B, that you've got a feel for what people need to know, which is good. So just going for the questions that people have. We've got one from Colin here who says, well done for navigating the COVID upsets. But as COVID recedes, what keeps you awake now? What are the concerns you have on your radar?
Yeah, well, I pointed out a couple of those remaining problems that we're resolving. We still want to do some debt liability management. There's a great opportunity there with those bonds trading below par. We still got a couple of aircraft to deal with. COVID is still impacting us. When we move aircraft around between airlines, we send them into maintenance to get shops. Half the maintenance team are not there, so things are taking twice as long. It's taking a lot of manpower, a lot of brain damage. Those things are still impacting us, but clearly they're receding. What we're seeing now is that banks are returning to the fold. They want to lend. Airlines are returning to the fold. They want to lend. And I think our biggest issue is that we've got to remember how to be that growth company that we were pre-COVID. We were sailing along, or flying along, should I say, adding 8 to 9 aircraft a year, doubling the fleet size every 3 years. And we've had to stop and play defense for the better part of 3 years now. We've been blocking. It's time to actually, break those shackles, hit a few balls to the cover, and just remember how to do that. And a lot of our team have been, focused on these problems, and we've just got to, internally reset ourselves, start being positive, and start looking to opportunities in the future. So, we are worried about the economic situation. We are, interest rates. We've always had a mitigation strategy and we've operated very successfully in property in higher interest rate environments than we are in the current day. So we feel that we can deal with that. Getting access to finance is obviously extremely important. So I think how investors will judge us over the next year will be getting access to aircraft, getting access to finance, and that debt liability management. I think that if we can start scoring some runs in regard to those issues, then that discount to NAV per share will become lower and lower and lower, because people will realize that, okay, this company is back. I think our results have taken the market a little bit by shock. And I know the negativity in the UK investing environment at the moment, but we can't worry about that. We can only worry about what's on our plate. So we're trying to deliver that. And we know that if we keep telling the story, we keep delivering those results, that you keep hitting balls to the boundary, eventually your score will build up.
I mean, historically, if I did a little bit of research, but historically you were paying quite chunky dividends, weren't you?
Yeah, I think our last year was about 3%. We initially, because we're such a high growth company, we did reinvest a lot of funds into fleet growth. But as the company matured, as we got certainly towards $100 million revenue, we started paying that dividend and growing it quite significantly. So we really wanted to position the company as a bit of a unicorn, in that it was a company that had high, and it wasn't going to double in size every 3 years forever. So that growth was not always going to be 25, 30% a year. But if that growth came down a little bit, that would enable that dividend to keep being paid, because the less you grow, the more spare capital you have to release as a dividend. So we wanted to be that unicorn that had high double-digit growth, but also a really strong yielding dividend. And it gave every investor in the market a reason to buy the share. And I think that we'd achieved that to a certain extent. Now pre-COVID, when the share price was, close to £3.50, we had a lot of institutional buying and all that sort of thing. And all those institutions sold out last year. And I think that's one of the reasons why our share price, took such a caning, is that, we got big enough to get institutions and I think they owned about 25% of the company. And they've all exited effectively over the past year and a half, and that's really been a hindrance to the share price moving forward. I know I see one of the questions there are about skin in the game, and I normally mention this during the process, but the board, senior management, including myself, we own over, I think, 22-23% of the shares of this company. We are fully invested in this company, and it's why we worked so hard pre-COVID, and it's why we worked so hard to enable it to survive during COVID. And I think that is one of the great attributes of this company, that it does have that strong senior management and board following. And as long as we're here, we're believers in the company and its opportunities. So I think that made us work extra hard and make us work extra hard in the future.
Yeah, well, as I say, you've answered that question. There's a couple more there, but just so I think we're clear, I mean, it seems to me that you're trying to balance the growing the company, getting more planes, and managing your debt profile. I mean, what's the priority? I mean, is it to opportunistically buy back that expensive debt when it's available?
Yeah, I can't provide too much guidance on that, because the market literally, you can be offered a plane to purchase tomorrow, and the bonds which are trading, the last trade I saw was 80 cents in the dollar. They trade at 70 cents in the dollar, and all of a sudden they're a pretty compelling trade. The lower they go, the more you want to buy them back. So what we're just trying to outline to investors is, we've got a liquidity position. We feel our cash collection is going to go good this year. We've got some planes to sell that will release some cash. And those are the two things that, are priorities for us. And we want to kind of do both. And we ideally like to do both. But, we've got to tackle the problems that are in front of us and take the opportunities that are in front of us, and take the best opportunity that's there at the time.
Okay, so we'll just go to the questions. Someone's asking about the valuation of aircrafts, and how often do you value them, and how is this done?
Yeah, and we typically do it once a year as part of the audit process. So, that involves a process of third-party valuations. It's checked by the auditor. They look at all the data points. Obviously, the spot market for aircraft was terrible, and that drove a lot of the impairment. The $130 million of impairment that we took, and effectively we've only written back about 20 or so of that. So, and look, some of that was needed. When airlines went bust and we did restructure some deals like the PAL deal, they kept the plane, but they're paying less rent, so that plane's less valuable. So we impaired that. We've taken that impairment. It's not going to come back, but there are, as we see valuations rise in the industry, we did take the opportunity to look at that, and the evidence and data supported that, and the third-party valuation supported that as well. And there could be opportunity to do that in a small amount in future periods as well.
Because I think our last question here, sorry, I think our last question here, in a sense, relates to that, because obviously the other side of valuation is what lease rates are. And we all remember, in the height of COVID, that virtually every desert in America seemed to become a parking lot for planes. you know, and that creates the impression that you know, there were too many planes around, but equally it was an exception.
Well, there wasn't pre-COVID. That's the thing. You know, the demand for planes was off the scale. You know, Boeing and Airbus were producing 50 narrow bodies a month, and they were sold out for years. So you know, what happened was that there's been a real commoditization of air travel. You know, you could get low ticket prices anywhere in the world, fly anywhere you want the next day, use your mobile phone to book a ticket. And you know, there were lots of competition out there, and airlines were still going bust, but people wanted and demanded to travel. So look, in terms of where
we're lease rates now, yeah, how do the lease rates compare to what you were getting before?
Yeah, look, they're going up is probably the best I can answer that I can give you, because it is still quite specific on a plane by plane type. You know, if you had a wide body large aircraft right now that was sitting on tarmac and you were trying to find an airline that wanted to take it, it'd be a pretty hard job to do. But fortunately, you know, 83, you know, the two airlines that had our wide bodies kept them. You know, Power had to restructure, unfortunately, but that's the way the cookie crumbles. But you know, the vast majority of our fleet were regional and narrow bodies, and we've seen the valuations and the lease rates on those bounce back pretty quickly, especially in the ATR sector, especially for certain types of narrow bodies. And the narrow bodies that are most popular are narrow bodies that we have. You know, the Airbus A220, which is a new technology aircraft that Air Baltic has with us. That's in extreme high demand. Those lease rates are at least comparable to pre-COVID. And in fact, valuations of the plane in some instances have gone above pre-COVID levels, simply because there are less planes out there and people just want the best ones. They want the new technology narrow bodies, especially the Airbus products. You know, Boeing still has a bit of stigma attached to it as a result of the crashes of the MAX and the recertification of that plane. But that plane has a very bright future, and I'm sure in a year or two's time, people will probably forget about that and won't notice when they get on those planes. But those planes we're seeing very high demand for. But you know what you want, and this is part of our investment philosophy, is you want to invest in young, popular types of aircraft. And young because they have the most economic benefit, and popular because airlines will continue to go bust. And if you have popular aircraft in a popular seat configuration with a popular engine, you take that plane and then you call every other airline in the world that uses that plane in that seat configuration with that engine, and they'll, you know, and that's who you're going to reposition that plane with. You have something a bit obscure, that's old, that's in a weird seat configuration with engines that nobody uses anymore, you know, you've got a much bigger problem. So it is a bit, I know that doesn't necessarily answer the question, but, you know, a part of our investment philosophy is to focus on, you know, the things that the bulk of airlines really like. And
no, I get that. A lot of it
that's
is
helped
about
us during COVID to reposition stuff.
Yeah, exactly. I get that's a real priority, to make sure that you have the right products, that you manage your fleet appropriately, and presumably energy volatility is something that makes that doubly important, that no one wants.
Yeah, well, look, airlines have always focused on the most fuel efficient aircraft, and all the new aircraft are always the most fuel efficient. And you know, the energy, yeah, we go through energy spikes, and you know, every couple of years, and it hammers airlines, which is why they end up leasing aircraft, because banks don't want to lend to businesses that are completely exposed to that energy trade. You know, and the price of fuel goes up by 20%, and every airline in the world loses money. That's why banks want to lend to lessors, and that's why lessors have a very strong future in aviation moving forward.
Well, listen, Richard, that's been extremely insightful. I mean,